This is a customs declaration form, CBP Form 7501, the document that accompanies every shipment entering the United States. Until yesterday, the tariff code for refined copper cathode was 7403.11.00, with a duty rate of 0%. Copper flowed freely into the country from Chile, Peru, Canada, Mexico. Wherever production existed, American manufacturers could access it at global market prices. At 6:47 p.m. Eastern on Thursday, President Trump posted on Truth Social, "The United States will no longer be ripped off on copper," announcing 67% tariff on all copper imports effective in 30 days. America's copper will be made in America. Details coming. Within 14 minutes, copper futures on COMEX had risen from $4.82 to $5.47 per pound, a 13% move in the time it takes to order dinner. By Friday's close, copper was trading at $6.12, up 27% in less than 24 hours, the largest single-day percentage gain in copper market history. But the price move isn't the story. The price move is the symptom. The story is the 847,000 tons of copper that shorts had sold into the market, betting that prices would fall, and the mathematical impossibility of covering those positions when a 67% tariff makes imported copper $4 per pound more expensive than domestic supply that doesn't exist in sufficient quantity. The short squeeze isn't coming, it's happening, and the traders caught on the wrong side are facing losses that could destabilize the entire commodity derivatives market. Here's what they're not telling you. The copper market's short positioning heading into Thursday was the most extreme in 20 years. Managed money held net short positions of 67,400 contracts, 337,000 tons of copper they had sold but didn't own. Commercial traders, refiners, fabricators, and trading houses held an additional 102,000 contracts of short exposure, representing 510,000 tons. Combined short interest, 847,000 tons of copper that the shorts must eventually buy back or deliver. To put that number in perspective, the entire COMEX warehouse system holds 22,000 tons of deliverable copper. The shorts have sold 38 times more copper than physically exists in exchange warehouses. In a normal market, this ratio isn't dangerous because shorts can always acquire copper from global markets to satisfy obligations. A 67% tariff eliminates that option. If the tariff takes effect, imported copper that costs $4.50 per pound globally will cost $7.52 per pound to bring into the United States. Domestic copper, produced at roughly 1.1 million tons annually against consumption of 1.8 million tons, trades at whatever price American buyers must pay. The marginal price becomes the tariff-adjusted import price, $7.52. But the shorts sold copper at $4.50, $4.60, $4.80, prices that assumed they could access global supply to cover. They cannot cover at those prices anymore. They must cover at $7.52 or higher, because that's what copper will cost in a tariff-protected market. The math is brutal. A short who sold 100 contracts at $4.50, representing 12.5 million pounds of copper, faces a loss of $3.02 per pound if forced to cover at $7.52. That's $37.75 million in losses on 100 contracts. The total short position of 847,000 tons represents 1.87 billion pounds. At $3.02 per pound of loss, the aggregate short position is underwater by $5.6 billion. $5.6 billion in losses that will be realized if the tariff takes effect and shorts are forced to cover. The losses don't disappear if shorts hold their positions. They accumulate daily as margin calls drain capital and exchanges demand additional collateral. This is where the lie becomes unsustainable. The shorts' only escape is for the tariff to not take effect. They're betting, hoping, that Trump's announcement was a negotiating tactic, that the 67% will be reduced in implementation, that exemptions will be carved out for existing contracts. They may be right. Trump's tariff announcements have frequently been modified before implementation. The aluminum tariffs of 2018 started at 25% and were adjusted with country-specific exemptions. The steel tariffs followed a similar pattern. Copper might follow the same playbook. But the market can't wait for implementation to discover the outcome. Margin calls happen daily. Position limits trigger automatically. Exchanges increase collateral requirements when volatility spikes. The shorts must manage their exposure now, based on the risk that the tariff takes effect as announced. At 8:15 a.m. Eastern on Friday, the CME Group announced emergency margin increases for copper futures, from $4,100 per contract to $8,200 per contract, effective immediately. The doubling of margin requirements forces every short position holder to either deposit additional capital or reduce positions. For a trader short 1,000 contracts, the margin call is $4.1 million, due immediately, before the close of business Friday. Traders who can't meet the call must liquidate. Their buying to close short positions pushes prices higher. Higher prices increase losses for remaining shorts. More margin calls follow. The cascade accelerates. This is the mechanics of a short squeeze. Not a single dramatic moment, but a grinding process where each price increase forces more covering, which forces more price increase, which forces more covering. The process continues until shorts have fully liquidated, or the fundamental catalyst, in this case the tariff, is removed. At 11:30 a.m. Eastern on Friday, White House press secretary confirmed that the copper tariff announcement was under active policy development with implementation timeline as stated. The confirmation removed hope that the announcement was rhetorical. The tariff is real. The 30-day timeline is real. The shorts problem is real. The press secretary added that the tariff was designed to ensure American copper production meets American copper needs, language that suggests domestic production incentives rather than negotiating leverage with foreign suppliers. The framing points toward implementation rather than withdrawal. Less than 29 days remain before the tariff takes effect on April 24th. In those 29 days, shorts must decide: cover now at $6.12 and lock in losses, or hold and risk covering at $7.50 or $8 if the tariff survives. The decision tree has no good options, only bad and worse. While one side scrambles, the other side calculates. The longs who held copper positions into Thursday's announcement are sitting on windfall profits, but the informed longs aren't selling into the squeeze, they're adding to positions, recognizing that the squeeze has further to run. At 3:45 p.m. Hong Kong time on Friday, Trafigura, one of the world's largest commodity trading houses, reportedly increased its COMEX copper long position by 12,000 contracts, representing 150,000 tons. Trafigura has physical copper operations globally. They know the logistics of moving metal, the costs of tariff-adjusted imports, and the price required to incentivize domestic production that takes years to develop. When a physical trader with Trafigura's expertise adds to longs during a squeeze, they're telling you their models show prices going higher. They're not gambling on sentiment. They're calculating the price required to balance a market where 67% tariffs make imports uneconomical. Glencore, another major commodity trader, reportedly converted 8,000 contracts from calendar spreads to outright longs, a repositioning that signals expectation of near-term price increases rather than eventual normalization. The physical traders are betting on the squeeze intensifying. The repositioning makes sense when you examine American copper supply. The United States produces approximately 1.1 million tons of copper annually from mines in Arizona, Utah, New Mexico, and Montana. Domestic consumption is 1.8 million tons. The gap, 700,000 tons, must be imported. A 67% tariff on 700,000 tons of imports adds approximately $4.6 billion in annual costs to American copper consumers. That cost must be absorbed by manufacturers, passed to consumers, or avoided through demand destruction. None of those options happens quickly. In the near term, the tariff simply reprices copper for American buyers. The domestic producers, Freeport-McMoRan, Rio Tinto's Kennecott, BHP's Resolution project, cannot rapidly expand to fill the import gap. Mining expansion takes 7 to 15 years from permitting to production. The Biden administration permitted 0 new copper mines in 4 years. The supply response to this tariff won't arrive during this decade. The price that balances American copper supply and demand under a 67% tariff isn't $6.12. It's whatever price rations 700,000 tons of demand until supply eventually expands. Rationing through price means prices rise until enough demand is destroyed. Manufacturers moving offshore, products redesigned to use less copper, consumers accepting higher prices for copper-containing goods. The equilibrium price under the tariff is estimated between $7.50 and $9 per pound by commodity analysts who have modeled similar tariff scenarios. At $8 copper, the remaining short position loses an additional $3.5 billion beyond current losses. The total damage to shorts could reach $9 billion if the squeeze runs to tariff-implied fair value. At 7:30 a.m. Eastern on Saturday, Reuters reported that several hedge funds with concentrated copper short positions had requested meetings with their prime brokers to discuss portfolio restructuring options. The phrasing suggests negotiations over margin forbearance, requests to delay margin calls while positions are unwound in an orderly fashion. Prime brokers granting forbearance would slow the squeeze. Prime brokers refusing forbearance would accelerate it. The outcome depends on relationships, collateral, and risk appetite at institutions whose names won't become public unless the losses force disclosure. This is what a market looks like when a policy shock meets extreme positioning. The shorts didn't do anything irrational by historical standards. They bet that copper prices would fall because global supply was increasing, demand growth was moderating, and no catalyst for a spike was visible on the horizon. The tariff announcement wasn't on anyone's horizon. Trump hadn't mentioned copper specifically in campaign speeches. His trade advisors had focused on steel and aluminum, metals with more political resonance in swing states. Copper tariffs emerged from nowhere, blindsiding a market positioned for the opposite outcome. The shorts were wrong. In markets, being wrong has consequences. The consequences here are $5 to $9 billion in losses for traders who sold copper they didn't own into a market that just made acquiring copper dramatically more expensive. Some will look at the copper squeeze and see manipulation, will accuse the administration of market interference, will demand investigations into who knew about the tariff before the announcement, will cry foul because their positions lost money. These voices miss the point. Tariffs are policy. Policy changes markets. Markets that position contrary to policy direction lose money. The shorts bet against a tariff that was always within the administration's authority to impose. They lost that bet. The loss is theirs. Others will recognize what the squeeze reveals about copper market structure. That 847,000 tons of short interest against 22,000 tons of deliverable inventory was always unstable, requiring only a catalyst to expose the imbalance. That domestic copper production covering 61% of consumption leaves the market structurally dependent on imports. That a protectionist administration was always likely to target that dependency. The informed are not predicting where copper prices peak or when the squeeze ends. Squeezes can extend beyond fundamental fair value as forced covering overwhelms price discovery. They can reverse sharply if the policy catalyst is removed. The informed recognize that the positioning disaster is real, the losses are accumulating, and the tariff timeline creates urgency that prevents orderly adjustment. This is not financial advice. This is not a recommendation to buy copper or copper miners or short more copper or take any position based on tariff announcements that can be modified or withdrawn. This is simply a description of what happened Thursday evening and what it means for traders caught on the wrong side of the largest copper short position in 2 decades. 67% tariff. 30 days to implementation. 847,000 tons short. 22,000 tons available. $5.6 billion underwater already. $9 billion at risk if the squeeze runs. The customs form that used to show zero duty now shows 67%. The copper that used to flow freely now costs $7.52 to import. The shorts who bet on global supply now face a closed border. President Trump posted at 6:47 p.m. By 7:01 p.m. the squeeze was underway. By Friday close, $5.6 billion in losses had materialized. 29 days until the tariff takes effect. 29 days for shorts to cover, or be covered. The squeeze isn't a prediction, it's arithmetic. 847,000 tons short, 22,000 tons available, 67% tariff. Do the math. Then watch what happens to anyone still short when April 24th arrives.